Hi there, I'm Jim Martin, financial advisor with Martin Wealth Solutions and host of Retirement Answers Today. This week, I had a question from one of my dear clients that I thought a lot of people are probably weighing right now. And the question was this: how is retiring during COVID different than 2 or 3 years ago? What are the things I need to be aware of and thinking about as I enter the world of being a retiree? And it's a great question. A lot of people are struggling with that. So that's what we're going to talk about on today's segment. Hey, before we get started, do me a favor. There's a subscribe here button. Make sure you click on that. I don't know if I was pointing in the right direction, but you'll see it. It'll say subscribe. Click on that. We do try to release new content on a regular basis, and I want to make sure that you have the ability to be in the know. Now, let's just jump right in. Look, during COVID, things are different. No doubt about it, including retirement. And we need to think about how the world today of finance will change the world of retirement. So let's start with some obvious things. Number one, I think interest rates. I don't know if you've known this, but interest rates are really, really low right now. Go to the bank, get a mortgage, and you can get a mortgage at an all-time low or close to it. Or go to the bank and get a CD, and you also get a CD rates at, well, it feels like all-time lows. So what that means for a retiree is as we get closer to retirement, we might shift from having 80% in the market or 100% in the market to maybe having less in the market and more in fixed income. That's a real impact for us when rates are low, because that means that our projected yield on those fixed income assets will potentially be lower. So we have to mitigate some of that. We have to be really well aware of that. And then we have interest rate risk. What happens if interest rates go up? Well, then we're in this inverse relationship where interest rates go up, but the value of your bonds goes down. So there's a lot more risk, and they're a bit more magnified right now than maybe just 3 or 4 years ago. Now, look, I've been waiting personally for rates to go up for 12 years now, and they really haven't budged that much. Maybe they went to 3% at some point. But the reality is rates have been low for a long period of time, and they probably will remain low for a bit longer. I don't know what the market will do. I don't know what rates will do. Nobody knows that stuff. But what we do know is that retirees are under pressure right now because some of the fixed income investments that they've been used to being able to invest in that provided better rates of return, they're just not as prevalent today. Now, at our offices, we do have some strategies, some workarounds that I think are working really well for retirees to put them in a better position. So again, if you want to learn more about that, you can click on the link below, and we're happy to share that. But I do think that if you do it on your own, you just have to be aware that rates are low, and that's gonna impact some of those dollars from a return perspective that maybe we're going to get twice the amount of return just a couple of years ago. So I think it's one thing that we have to be really well aware of. The two other ones that I think are really big and that bear some attention are, number one, market risk. We've had a bull market for a number of years. The market's just run pretty fast. It's run up. We've had some volatility along the way, but let's be honest, it's been a lot of this. It hasn't been a lot of this. It's just been, it goes up and it pushes up like that. And what that means is it doesn't really mean anything except that eventually the market will correct because markets follow business cycles, and eventually the federal government will stop pumping so much money into the market, and we're just going to have to be aware of what that does. I don't know how much it'll correct. It might be very temporary. It might not correct for 10 years, by the way. The reality on the market is it's going to go up and it's going to go down, and really nobody knows in what order. I have the pleasure of working with a lot of people, and they sometimes call me and say, Jim, I got this newsletter that said the market's going to drop next week by 20%. How does this person know this, and why are they telling you? So nobody knows is my whole point. So I wouldn't put a lot of stock in that. But with that said, you better have a portfolio that you understand what's going to happen if the market does drop. So if the market does pull back, are you ready? That's the thing that we're talking about here. You've got to make sure that you're ready if the market does pull back. So if it pulls back, you're positioned with the right amount of fixed income and the right amount of equity. So maybe you don't feel the full brunt of it. So just be really well aware of that as we continue to see some pressures out there from the federal government printing money and potentially raising taxes and doing all these other things, that you're prepared for what happens if the market were to decline. And that's the last part of what's different today is, I think I think taxes are a huge issue, and I think they're going to continue to be an issue for retirees because I don't know this conclusively. So, this is more of an opinion, but my opinion is that taxes are going to go up. I just don't see another way you can print money at the way we are and send out stimulus checks after stimulus checks and send out free money and trillions of dollars of spending bills and not have taxes increase. It just doesn't make sense mathematically to me. And when taxes increase, understand that even if taxes only increase 3 or 4%, that might be 3 or 4 less percent that you have in your take home every month. And when you're on a fixed income, that's a real issue. When you were working, it's a little different because maybe your employer gave you a raise, you could work more hours, or you could change jobs to increase your wages if they weren't satisfactory. But the challenge for retirees right now is if we get higher taxes and higher inflation, that's going to mean less money in your pockets. And less money in your pockets means a decline in your standard of living. So good planning will really handle a lot of this because it'll allow you to understand what your capacity for change is. And you might have to be nimble, guys. You might have to reduce spending. You might have to look at different investments. You might have to look at some different fixed income investments. The world is different. It's not completely different. Like your grandkids are still going to be there and want to see you. You're still going to want to travel. You're still going to want to go to restaurants. Maybe you've got to wear a mask at some of these places for a bit. But short of that, what I'm really worried about is the financial world. I'm worried about inflation, market risk, and taxes. Those are the 3 big ones that we're focused on at our firm with our clients. Look, if you want to learn more about that, make sure you click in the links. You'll see a Calendly link. Happy to spend 15 to 20 minutes with a visit with you to talk about that. But more than anything, I hope this will allow you to think about your world and your investments a little different. Make sure you have rising income. Make sure you account for inflation. Make sure you account for taxes. The time is now. Don't wait to do this. The sooner you can put these plans in place, the better off you'll be, in my opinion. More than anything, thanks for watching. Make sure you click the subscribe button. If you like this video, click the thumbs up. That helps us get recognized by the algorithms on YouTube so other people see it. We'll talk to you next time. This is Retirement Answers Today.